Welcome everyone, we're going to dive into the world of annual reports. Annual reports are a treasure trove of information for investors, providing crucial insights into a company's financial health, its strategy, and overall management. But do you know what to look for in these detailed documents? Today, we'll be exploring the key elements that one of the most successful investors of all time, Warren Buffett, looks for in annual reports. Annual reports are essential tools for investors. They provide a comprehensive overview of a company's operations over the past year, including its financial performance, strategic initiatives, market positions, and future plans. This wealth of information can help investors assess the company's potential for future growth and profitability. One of the key aspects of annual reports is their role in providing insights into a company's financial health. Through balance sheets, income statements, and cash flow statements, investors can gain a clear understanding of a company's financial standing. These financial statements can reveal patterns and trends that might not be apparent from a simple glance at a company's stock price. In addition, annual reports offer a glimpse into a company's strategy and management. The management discussion and analysis section, for instance, gives investors a sense of the company's strategic direction, while the corporate governance section sheds light on the company's leadership structures and practices. But perhaps the most significant value of annual reports lies in their role in promoting transparency and accountability. Companies are legally required to provide accurate and complete information in their annual reports. This ensures that investors have access to reliable data on which to base their investment decisions. Warren Buffett, often referred to as the Oracle of Omaha, is widely regarded as one of the greatest investors of all time. His investment philosophy, grounded in the principles of value investing, has resulted in a remarkable track record and built Berkshire Hathaway into a multinational conglomerate holding company. Buffett is known for his meticulous analysis of annual reports, which forms a critical part of his investment decision-making process. He delves deep into these documents, looking beyond just the numbers to understand the business's fundamentals and its long-term prospects. His approach is grounded in finding companies with durable competitive advantages, often termed economic moats. These are businesses that have built barriers against competition and can maintain their market position over the long term. Buffett believes that such companies, when purchased at a reasonable price, can generate significant returns over time. When it comes to dissecting annual reports, there are several financial metrics that Buffett pays close attention to. Firstly, revenue and revenue growth trends. Buffett looks for companies with consistent and growing revenue streams. He views this as an indication of a strong, sustainable business. Secondly, earnings per share, EPS, and its consistency. For Buffett, a steady or increasing EPS suggests that the company is profitable and managing its resources effectively. Next, return on equity, ROE. This metric measures profitability by comparing net income to shareholders' equity. Buffett prefers companies with high ROE as it indicates they're using investors' funds efficiently to generate profits. Debt levels also play a crucial role in Buffett's analysis. He prefers companies with manageable debt levels as heavy debt can pose significant risks, especially during economic downturns. Lastly, free cash flow. This is the cash a company generates after accounting for capital expenditures. Buffett values companies that generate robust free cash flows as it allows them to invest in growth, pay dividends, or reduce debt, all of which can enhance shareholder value. One of the key principles in Warren Buffett's investment philosophy is the concept of a company's moat. This refers to a business's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share from competing firms. Identifying a company's moat through annual reports involves looking for unique products or services, brand strength, or technological advantages. These are characteristics that give a company an edge over its competitors and make it difficult for others to replicate their success. Assessing the company's market position and competitive landscape is also crucial. A company with a dominant market position or operating in an industry with high barriers to entry likely has a strong moat. Finally, evaluate customer loyalty and pricing power. Companies that can maintain or increase prices without losing customers often have strong brand loyalty, another sign of a durable moat. The quality of a company's management team plays a significant role in its success, and Buffett places great emphasis on this aspect. He believes in investing in companies run by competent and honest people. You can gauge management's competence and integrity through annual reports. Start by reading the CEO's letter to shareholders. This can provide insights into the company's strategy, challenges, and future plans, and Buffett often uses it to understand the leader's vision and capability. Look for transparent and honest communication throughout the report. If a company openly discusses both its successes and failures, it's a good indication of management's integrity. Lastly, check if management's interests align with those of shareholders. This might be reflected in the way profits are used, such as reinvesting in the business, paying dividends, or buying back shares. When management's actions benefit shareholders, it's a positive sign of their commitment to creating shareholder value. Recognizing and understanding the potential risks a company faces is just as important as identifying its strengths. In fact, Warren Buffett pays close attention to the risks and challenges outlined in annual reports. To identify potential red flags, start by reading the Risk Factors section. This part of the report outlines the various risks that could potentially impact the company's operations or financial performance. Also, assess how the company plans to mitigate these risks. A company with a clear, well-thought-out risk management strategy displays foresight and preparedness, which are qualities Buffett appreciates. Lastly, keep an eye out for any regulatory or legal issues the company might be facing. These issues could pose significant risks and are often disclosed in the annual report. To help illustrate these principles, let's consider some real-world examples. One example is Buffett's investment in Coca-Cola. He was drawn to the company because of its strong brand, a significant moat, consistent earnings growth, and excellent management. The annual report provided insights into these aspects, guiding his decision to invest. On the other hand, there's the case of IBM. Buffett initially invested in the company based on its strong financial metrics and dominant market position. However, he later sold his shares after realizing that the competitive landscape was changing faster than IBM's ability to adapt, a risk that became apparent through careful reading of the company's annual reports. These cases highlight the importance of thoroughly analyzing annual reports. While they provide a wealth of information, it's crucial to know what to look for and understand how to interpret the data. As we can see from Buffett's approach, this involves a detailed analysis of financial metrics, a deep understanding of the business and its competitive landscape, an assessment of management quality, and an acknowledgement of potential risks. Now that we've learned from Warren Buffett's approach, let's talk about how you can apply these insights to your own investment analysis. Here are some practical tips. Start by selecting a company you're interested in and download its most recent annual report. Begin with the CEO's letter to shareholders to get an understanding of the company's performance, strategy, and future plans. Analyze the financial statements and key metrics. Look for trends in revenue, EPS, ROE, debt levels, and free cash flow. Investigate the company's competitive advantages. What sets this company apart from its competitors? Evaluate the management team. Do their actions align with shareholder interests? Don't skip the risk factors section. Understand the potential challenges the company might face. Remember, practice makes perfect. The more reports you read, the better you'll become at identifying promising investment opportunities. In conclusion, reading and understanding annual reports is a crucial part of making informed investment decisions. As we've learned from Warren Buffett's approach, it's not just about the numbers, it's also about understanding the business, assessing its competitive advantages, evaluating the management team, and acknowledging the potential risks. We hope this video has provided valuable insights into using annual reports for investment analysis. If you found this information helpful, please like the video, subscribe to our channel, and share this video with your fellow investors. Remember, investing is a journey, and every piece of knowledge brings you one step closer to your financial goals. Thank you for watching.